How crypto markets work. One day crypto is up 10%, the next day it drops 15. Stocks rarely move like this. So what actually makes crypto prices move so fast? Today, we break down the engine behind the market. First, let's talk about how crypto prices are set. A lot of beginners assume Bitcoin has one official price somewhere online. It doesn't. The price you see is simply the latest trade that happened between a buyer and a seller. Think of it like a giant global marketplace running nonstop. Someone wants to buy Bitcoin. Someone else agrees to sell at a certain price. That trade becomes the latest market price. Now imagine more people suddenly want to buy than sell. Buyers start competing with each other, offering slightly higher prices. The market moves up. But if more people want to sell than buy, sellers start accepting lower prices just to exit quickly. The market moves down. That's supply and demand. And in crypto, it updates every second, 24 hours a day, because crypto markets never close. There's no bell ringing at the end of the day like the stock market. Next, let's talk about market cap. This is one of the most important ideas for beginners. Market cap means the price of one coin multiplied by the number of coins in circulation. In simple terms, it tells you the total size of a cryptocurrency. Why does this matter? Because price alone can be very misleading. A small coin can double in price much faster than a giant coin like Bitcoin, but it can also crash just as quickly. Smaller markets are easier to push around. This is why comparing coins by price alone doesn't really tell you much. A coin priced at $1 is not automatically smaller or cheaper than a coin priced at $100. Market cap gives the full picture. So why is crypto so volatile compared to stocks? One reason is size. Crypto markets are still much smaller than traditional stock markets. That means large trades can move prices more dramatically. Another reason is speed. Social media spreads emotion instantly. A rumor, a news headline, or a viral post can send prices flying up or down within minutes. Regulation matters too. If governments announce new rules, markets react fast. And then there are whales. That's the nickname for people or companies holding huge amounts of crypto. When whales buy or sell, the market can shift very quickly. Add nonstop trading into the mix and reactions happen instantly, day or night. Quick question. If a coin's price is $1, is it cheaper than a coin priced at $100? Think about it. The answer is coming up. The answer is not necessarily. Price alone means nothing without supply. A $1 coin with 100 billion coins in circulation could actually be a much larger market than a $100 coin with only 10 million coins available. This is why experienced traders look at market cap, not just the coin price. Focusing only on cheap-looking coins is one of the most common beginner mistakes in crypto. But markets are not driven by math alone. Human emotion plays a huge role too. When prices rise quickly, people feel greed. They rush in because they're afraid of missing out, also called FOMO. When prices crash, fear takes over. People panic and sell at the worst possible moment. That emotional cycle pushes markets higher and lower than logic alone would suggest. Understanding that markets are numbers and part psychology is one of the first steps to reading them clearly. So, to recap, crypto prices come from supply and demand, market cap matters more than price alone, volatility comes from smaller markets and fast-moving sentiment, and emotion drives many of the biggest swings. Follow us for weekly crypto education, made simple. This content is for educational purposes only and should not be considered financial or investment advice.